Unit 2, Area Study 1, where we're going to be looking at price setting strategies in the first aspect, which is Chapter 12. So the learning intentions are to investigate different pricing methods. So there are a set of pricing methods that we're going to be looking at where a business, sets their inventory or goods for. And then to calculate minimum desired profit, to calculate a profit or loss in general, and to prepare a simple income statement. So let's go. So let's compare a service business and a trading business. So also known as a service versus trading firm. So a service firm provides a service in return for a fee. So let's think about it like this. Has any of your parents booked like a lawn mowing service where individuals turn up to your house with equipment such as the lawnmower and mow your lawn, and then in return they expect a fee? And so this is known as a service firm because in return the form of revenue they receive is known as a fee. So now, whereas a trading firm buys goods, so also known as inventory, and then sells them for a higher price, this form of revenue is known as sales. So let's think about it like this. I set up a business and buy goods such as groceries from Coles, and then I sell it at a higher price. So this form of revenue that I'm making is known as a sale. Alright, so now there are different types of price setting methods that a business would set their service or goods for. Now there's the first one is RRP, which is recommended retail price. So generally this is a selling price suggested by the manufacturer. So before the business receives the product, the RRP is advised by the company who manufactures or makes the product. So it is a guide, but it's not mandatory. So that's why it's known as the recommended retail price. So this method is commonly used for items such as books and footwear because books and footwear are manufactured raw from a manufacturing company and then are sent in a stock to a company such as Dimex and let's say Skechers. So the next one is competitors' price. This method uses competitors' prices as a basis. A business can choose to match its competitors or even set prices slightly below the market advantage. So let's say you have Coles and Woolworths. So they're selling the same product. Let's say they're selling Nutrigrain cereal. So let's say Coles sells it for $4 and Woolworths, they might be okay. Well, we've got less stock and competitors. And well, since Coles is selling it for this price, we might as well sell it for a bit more than that, or maybe a bit less to attract customers. So it's based on your competitor. Next, market reaction. So generally, if the demand is high, a business may wish to increase its prices to maximize sales revenue. Alternatively, when demand is low, the business may decide to lower prices. So when the demand for a product is high, the reason that a business may wish to increase its price is because the product attracts a lot of people in the public. And let's say I want to buy a MacBook Pro. um I go to two stores, JB Hi-Fi or the Apple Store. Now, the demand for this product is really high because it's the latest gadget and people want to buy it, people want to get their hands on it. So eventually a business may decide to increase its price in order for people, the business to make more money in the end, because eventually people would want to get their hands on it despite the price. So these three techniques that we just discovered for setting selling prices are based on the owner's knowledge of the market and his or her observations. So the following two methods focus on earning profit and therefore requires some further calculations. So let's look into that. So the first calculation is known as a markup. So this method uses a predetermined profit margin that is added to the cost price to determine its selling price. So let's say if the cost price was $50 and the business applied $100 markup. Let's say, okay, this product is a watch. A watch costed $50, and let's say Proud's Jewelry added 100% markup. They would calculate 100% of the selling price, of the cost price, I mean, which is, $50, because, and then they would add it to it. So that would make the selling price $100 because it's marked up by 100%. So note that GST is added after the markup is calculated. So GST is not part of the markup process. So this method is popular for businesses selling electric goods and car industry. So yeah. The next price setting method is, break-even analysis as a technique. So this method is used to determine the number of products that a business may need to sell, or even selling price it must charge in order to break even. So the break-even point is known as a point where a business has zero loss or zero profit. So the break-even point is where, yeah. So let's say a business has to sell. Okay, let's say they have to sell 1,000 products to have a zero loss, a zero profit. So that's the break-even point. If they sell one product more or one product less, it's not. They won't match the break-even category. So the break-even quantity will be the minimum amount of sales. Any sales above this figure will result in increasing profit. And vice versa, the break-even quantity will be, if any sales below this figure will result in a loss. So important concepts with regards to break-even analysis. So there's a variable cost, which is the cost that change in direct proportion to sales. So for example, if one unit costs $10, two units will cost $20 because, if one unit is 10, you multiply it by 2 to get 20, and then 10 units will cost 100. So it depends on each unit of a product. Now fixed costs, wherever, are costs that remain the same regardless of the level of sales. So let's think about it. So an example would be rent and insurance, because they don't rely on the unit of a product, but it's as a whole. So fixed costs may change for other reasons, such as inflation, expansion, but not due to change in sale levels. So variable costs are usually expressed as per unit. So think about it like this. I might choose to sell, okay, let's say I have a grocery shop and I choose to sell apples. Now, if one apple costs $2, that's a bit too much for an apple, but if one apple, costs, let's say 75 cents, and I want to sell, a couple of apples. So I just multiply 75 cents being the cost of one apple by the amount of units I sell. Whereas a fixed cost, in summary, it's not measured by units, whereas it's measured as a whole. So let's say if I want to rent a property, and the rent price per week is $460, and there's another property that's a double story property which costs $470. Now you can't really compare those two based on a unit. So let's move on. So now there's a formula that we need to remember for the break even analysis. So now in simple terms, it's the quantity to be sold equals to the total fixed cost plus the profit divided by the selling price per unit minus variable cost per unit. So now the denominator of this equation is also known as the CM, which is the contribution margin, or known as the gross profit made on each item sold. So it is called the contribution margin because it is the amount that each item sold contributes towards covering fixed costs and making a profit. So you can also write this equation like Q equals FC plus profit divided by SP minus variable cost, or CM. So now this is a break-even graph. So you see, you have your loss, and then you have your fixed cost line, and then you have your variable costs, and then the break-even point is where the TR and the TC meet. So the Q1, my bad. That's the break-even point is here. So next we have an income statement. So when we do our income statement for a service business, we have to consider the sales, which is the selling price times the quantity sold, and then minus total variable costs, which is the variable cost times quantity sold, which gives you the profit. In so think about it like this: you have a shop, and the amount of sales you make, you multiply it by the quantity you sold. So let's say I sell an apple for $1, and I sold 20 apples. I have 20 I have $20 in total. Now let's say my variable costs, however, are 50 cents, and I have a lot of I have like what? Let's say I have a lot of variable costs. You minus the $20 from the variable costs times the quantity. So now you get the profit that you made, which is the surplus amount of money that you have, where you can, spend it as capital, or, withdraw it, do many things with it. Um, and then on the bottom, you have minus the fixed costs, which, includes the rent, the insurance, the salaries. Remember, fixed costs aren't measured per unit, they are more so measured as a whole. And this is why you have rent, insurance, salaries, advertising. And then this finally gives you the net profit. So that's how an income statement differs from, income statement for a service firm differs from the income statement for a business. So So the break-even analysis works on the basis that the following three assumptions exist. So remember, these are just assumptions. They don't, carry forward. They don't necessarily carry forward to the real world, but often assumptions will make accounting a bit easier and recording. So the first one is costs can be clearly identified as fixed or variable. So fixed being as a whole, like rent or insurance, and variable being per unit. Next, selling prices and costs remain constant, and then all goods bought will be sold. So there won't be any wastage of resources. Although this happens in a real world business service firm, you know, accounting will be hard if you include those. So technically, these three assumptions exist to make accounting easier. The knowledge we have acquired. So we have question 1, percentage markups. A clothing store is considering using a fixed percentage markup on the goods it sells. It currently sells 3 lines of stock with the following cost prices. Calculate the selling prices for each of the items if the following markups were used. So, all right, we have jeans being $40, t-shirts being $10, and baseball caps being $5. And they said each of those products were marked up by 3 different percentages or markups. So for the first one, I'll do the first one for jeans, and let you guys do the rest by yourself. So all right, so we have jeans being $40. Now that's the original price, or the cost price, but we want to find the selling price. So after the 50% markup. So basically what we're doing is 50% of $40, right? Plus $40. So a simple way you can write this in your calculator would be 40 times bracket 1 plus 0.5, and then you get the answer. So 1, the reason I wrote 1 is the 100% value, so you're adding 50% to the 100% value. So the 50% comes from the markup. So the answer for the first one is $60, which is the selling price after jeans have been marked up by 50%. So I'll let you guys pause the video if you want, and you can do the rest. And yeah, so here are the answers. So yeah, I hope you guys got that correct. And question about the break-even point. So School Student Representative Council (SRC) is considering selling a range of commemorative goods to Year 12 students. The principal believes that students should learn about the costs of running a business, so has agreed to rent the SRC a room for $60 a week, from which they can run their new business. The first item will be a rugby top. So the estimated price per rugby top is $45, and the students have decided to sell them for $50. If they can make a profit, they will use the extra funds to buy other items. Alright, so the first part of the question is, if the SRC went ahead with its plan, how many rugby tops would have to be sold in a week to break even? So we've been given a formula to calculate the break-even point. So or the quantity to be sold in order to reach the break-even point. So we have Q, which is the quantity to be sold, equals the fixed costs, the total fixed costs, plus the profit, divided by the contribution margin, which is the selling price minus the variable costs. So let's construct our equation here. So we have our fixed costs being $60, due to rent being $60 a week, and then we have here our profit. So in a break-even analysis, the profit is mostly zero, because to reach a break-even means you have a no loss or no profit. So that means we have a profit of zero, it's our assumption, and divided by the selling price. In this case, the selling price is $50 per rugby top. So we'll say $50 minus the variable costs, which are what they are selling per unit. What they purchased, what they spent per unit. So per rugby top, it's $45. So with this being our equation, when we solve it, we get 60 divided by 5, which results in 12 rugby tops to be sold. So in summary, the SRC in this scenario needs to sell 12 rugby tops in order to break even, meaning they'll have no profit or no loss. So if they sell more than 12, they'll have a profit. If they sell less than 12, then they'll have a loss. So alright, let's look at the second part of this question, which requires us to prepare a simple income statement to prove our answer. So let's go to an Excel doc, and we will make an income statement template. So we will add some borders. Okay. Alright. So to begin with, we have our sales, in which we have the quantity that we need to sell, which is 12 rugby tops, multiplied by the selling price. So the SRC is selling their rugby tops for $50. So the sales would be the selling price times the quantity, which in this case is $600. Now you have minus the variable costs. I'll just say VC, which in this case is 12, which is the quantity again. Now, what's different from the sales is that the variable costs have a different price multiplied by the quantity, which is $45, because per unit or per rugby top the SRC purchased, they spent $45. So now when you minus, now this results in 540, so minus 540 from 600, and then you get the contribution margin, the CM, which is the sales minus the VC. You get a total of $60, right? So that's the end result. Now the other part of the income statement is is fixed costs. In this case, what do we agree upon saying that the fixed cost was? Before we discussed that the fixed cost should be the rent, because you're not spending per unit, you're not spending money on per unit. So now we have a subdivision of the rent. Oh, my bad. Rent being $60, right? Now, to get the net profit, you have to minus the contribution margin, right? You have to minus the contribution margin from the the fixed costs, the total fixed costs, to get the net profit. And the net profit is the surplus of how much is left, in which a business can use either for capital or withdrawals or whatever. So in this case, when you minus 60 from 60, you get 0. So that's the break-even point, right? So it's 0. So this is our income statement, a simple income statement from this scenario. So how many tops would have to be sold to earn a weekly profit of $100? So okay, let's model our equation again. So we have a fixed cost being 60, right? Now plus the profit, right? We'll leave the profit to the end, and we'll just fill in the details that we know from the previous part. Selling price is 50 and variable costs are 45. So now the addition that they added in this part is to earn a weekly profit of $100. How many rugby tops do they need to sell? So instead of 0 before it was 0, but now it's $100. So let's solve, and we get 160 divided by 5, which is $32. I mean, my bad, not dollars. It's 32 rugby tops. So for part C of this question, the answer is the SRC needs to sell 32 rugby tops to have to earn a weekly profit of $100. And you can notice here that to earn a profit, you need to have a number more than 0, and you need to have a number of rugby tops more than 12 to earn a profit. So yeah, that supports this part. So the next part is, if the SRC increased its selling price to $55, what effect would it have on the break even? So okay, let's model our equation this time. now we have the SRC increased its selling price to 55. So let's fill out the fixed cost is $60. The profit is 0 because you wanna get the break even point. And then the denominator, however, the selling price will change from 50 to 55. And then the variable costs are the same. So the SRC are selling it for even more this time, meaning that they'll, be selling less or lesser, rugby tops than before. So 10, and then as a result, they'll be selling only 6 rugby tops to be breaking even. So now part E of this question, part E talks about if the principal increased the rent to $70, what is the new break-even point? Now, the assumption is the selling price is still $50. So, alright. So what we do, general trend is with these type of questions, you sub in a value for just changing the equation around. So we have everything the same except for the fixed costs, which is the rent. So from 60 it went to 70. Now this question's asking to break even again. So you have 0. Remember, whenever it says break even, you have to have the profit as 0. Now the selling price is still $50, and then the variable costs are 45. So now with the demand of rent or the fixed cost being higher, they would need to obviously sell more. So 70 divided by let's plug it in. 5. So they would need to sell 14 rugby tops this time in order to break even, which means for part E, we could say the SRC needs to sell 14 rugby tops in order to not have a profit or neither have a loss. This area of study in Unit 2 of Year 11 Accounting. So join you back in my next video for the next part.